I was at a small dinner party recently where a friend of mine, a high school teacher, was beaming with excitement. He'd just finished a side hustle and was bragging about how his smart investing and a perfectly timed mortgage refinance had finally given him some breathing room. He kept scrolling through his banking app, showing anyone who would look how his net worth had technically jumped over the last few years. There was this infectious energy in his voice, a feeling that despite the chaotic headlines, the average person was finally figuring out how to beat the system and come out ahead. But then the host mentioned the local school board's latest emergency meeting. Because of budgetary constraints and rising interest costs, they were slashing the music program and increasing class sizes. My friend's face dropped. In an instant, his pride in his personal wealth collided with the reality of his professional world. He started venting about how the money just isn't there anymore for the things that matter, seemingly unaware that the very mechanisms making his bank account look bigger on paper were the same ones hollowing out his classroom. It was a perfect, quiet snapshot of the trap we're all sitting in. Globally, we are staring at a $300 trillion debt mountain, a number so vast it has ceased to be money and has become a physical weight. We've spent years convinced we were getting a free lunch, fueled by printed trillions and near-zero rates that made borrowing feel like a gift. But the bill has finally landed on the table. Now the system is running out of tricks. We are being forced to choose between three bitter paths: watching our savings vanish through inflation, watching our public services crumble through austerity, or watching the entire global engine seize up into default. We aren't waiting for the crisis to arrive. We're already in the middle of deciding which poison we're willing to swallow. That story, it just perfectly captures the weirdness of this moment, doesn't it?
It's the dissonance. Yeah, the cognitive dissonance of our time.
Exactly. The stock market is at an all-time high, but the school roof is leaking, and the music program is gone. And that right there, that is the mission for this deep dive. We need to get under the hood of that $300 trillion number, because it's not just a statistic you can read in a newspaper. It's a structural change. It represents something fundamental shifting. And that shift is why the physical world around us, the schools, the bridges, feels like it's starting to break.
It's not an accounting problem anymore. You said it in the opening, it's a physics problem now.
A physics problem. Yeah. So where do we even start to diagnose a problem that big? What are the sources we're using to guide us through this?
Well, that's a challenge, right? To see the whole picture, you need to pull from very different angles. So we have a pretty diverse stack here. We're leaning heavily on the In Gold We Trust report, which is this massive, and I mean massive, annual study. It comes out of Liechtenstein, of all places, and it tracks hard assets, central bank behavior, all the real stuff.
The physical world.
The physical world. Then we've got the Bretton Woods 3 analysis from Credit Suisse. This is specifically the work of a guy named Zoltan Pozsar.
I know that name. He's legendary in banking circles.
He is. He's considered the expert on the, let's call it, the plumbing of the global financial system, the pipes and valves that nobody sees but that make everything work or not work. Right. And then to round it out, we've got academic papers, one from Sornet and Cowles on something they call the perpetual money machine, which is just as interesting as it sounds. And finally, some really dense but incredibly revealing economic data coming out of China on how they're handling their own debt situation.
So you've got a Swiss bank, a German-style gold study, academic theory, and Chinese state data. If you had to draw a single thread through all of those, what is the one big idea?
It's a collision. That's the word. We are watching a slow motion but incredibly high impact collision between two separate worlds that used to coexist peacefully.
And those worlds are?
The financial world on one side. So that's the realm of, paper promises, credit scores, stock tickers, currency rates, all the numbers on the screen.
My friend's banking app.
Your friend's banking app. Perfect example. And on the other side, you have the real world. That's commodities, factories, energy, food, shipping containers, the actual stuff.
Right.
For the last, say, 40 years, the financial world has been the boss. It called the shots. It told the real world what to do. But what these sources are all saying from their different perspectives is that the polarity is flipping. The real world is starting to take the wheel back, and the financial world is in the passenger seat, and it's starting to panic.
Financial versus real. That has to be the lens for this entire discussion. But look, $300 trillion is still an abstraction. It doesn't mean anything to me. I want to ground this immediately. I want to see where that weight actually lands on a person. I want to talk about Senor Roberto.
This is a perfect case study. It comes from some of the analysis on the European sovereign debt crisis, specifically looking at what's happening in Italy with their pensions.
Right. So I want you to picture this. An elderly man, Roberto, in a small town just outside Rome. He's in the local grocery store, the Alimentari. He's standing there and he's holding a block of Parmesan cheese. Parmigiano Reggiano.
A staple.
A staple. He's not starving. He's not destitute. But he's hesitating. He looks at the price, which has gone up again. He looks at the cheese, and he puts it back on the shelf. Now, if you zoom out on his life, this guy worked for 40 years. 40 years in a textile mill. He paid his taxes every year. He paid into the state pension system, the social contract, and that contract was crystal clear. You work now, you contribute now, and the state will guarantee your dignity later on.
The promise, the paper promise.
The paper promise. But that contract has been broken. His pension payments, they haven't gone up in years. They're frozen. Why? Because the Italian state is under these strict austerity measures. But at the same time, the price of that block of cheese has jumped 20%. Inflation.
And that single moment of hesitation in the grocery aisle, that is the exact point of impact. That's where the abstract financial world crashes into Roberto's real world. He's living through what the sources describe as a comparative analysis of state capacity.
State capacity, what does that mean here?
It means the state has a choice to make. It has two promises it's supposed to keep. One promise is to the bond market, the investors, the funds that hold Italian government debt. The other promise is to Roberto for his pension. And the brutal reality is it cannot do both.
But why not? I mean, why can't a sovereign country just pay its own people what it owes them?
To really get that, you have to dig into the mechanics of what Didier Sornet and Peter Cowles call the illusion of the perpetual money machine. It's a fantastic paper, and it identifies this huge regime change that happened in the Western economy right around 1980.
A regime change sounds dramatic. We're not talking about a coup?
No, but in economic terms, it was just as significant. It was a change in the very engine of growth. So think about the post-World War II boom, say 1950 to 1980. How did the economy grow?
We built things. We invented stuff.
Exactly. Growth was driven by productivity. We had massive technological innovation jet engines, transistors, the interstate highway system. We got better at managing factories. And because each hour of work produced more real value, real wages went up.
So people had more money to spend.
Right. And because wages went up, people could buy more things. Consumption was funded by production. It was a virtuous cycle. It was, I guess, capitalism working as advertised. You eat what you kill.
Yes, it's intuitive. What happened in 1980?
The mechanism broke. For a lot of reasons we could get into, productivity growth it slowed way down. It didn't stop, but it decelerated. We'd picked all the low-hanging fruit in the physical world, and the economy started shifting towards, optimization and finance instead of raw invention.
But our desire for more stuff didn't slow down.
In fact, consumption accelerated. We wanted bigger houses, second cars, more services, you name it. The standard of living we expected kept going up, even though the productivity to support it was flattening out.
So there's a gap. If we're not making enough extra real value to pay for that lifestyle, where did the money come from?
Leverage. We stopped funding our lives with income and started funding them with debt. We officially entered what the paper calls the age of credit. That massive gap between flat wages and rising consumption was filled almost entirely by borrowing.
And this is the financialization that everyone talks about.
This is it. And it's so important to be specific about what that means, because it's not just greedy bankers, you know? It's a deep structural shift where the financial sector stops being a utility, like the power grid that helps a factory run.
The plumbing?
The plumbing, exactly. It stops being the plumbing and it becomes the product itself. The Sornet paper has this incredible chart. It shows financial sector wages completely decoupling from the rest of the economy after 1980. And instead, they start tracking perfectly with one thing: total credit market debt. So the more debt the system creates, the richer the intermediaries in that system get. It had nothing to do with building a better car or a faster computer. It was all about creating and selling and securitizing debt.
So the Robertos of the world, the people working in the textile mill, their wages stagnated because the economy simply wasn't valuing their labor anymore. It was valuing the ability to package up a mortgage and sell it.
And that brings us right back to your friend at the dinner party. When he saw his net worth jump on his banking app, was it because he created more value for society, or was it because the asset he owned his house, his stocks, was being inflated by this giant ocean of new credit and liquidity.
It's the illusion of wealth.
It is the illusion. It's the perpetual money machine. It feels great. It works perfectly as long as interest rates are near zero and you can just keep refinancing the debt forever. But Italy, and by extension, Roberto, they're caught in a very specific, very nasty trap within that machine. It's something the Bretton Woods Project source calls the currency hierarchy.
Okay, that's a key concept. Explain how that works, because I think most of us assume, a euro is a euro, a dollar is a dollar, money is money.
It is absolutely not. Think of it like a caste system, but for national sovereignty. At the very top, in a class of its own, you have the core. That's the United States.
Because it issues the dollar.
Because it issues the world's reserve currency. The U.S. has what de Gaulle famously called exorbitant privilege. If the U.S. has a crisis, a financial meltdown, what does it do? It can print trillions of dollars, and the rest of the world has to absorb them because everyone needs dollars to buy oil, to trade, to settle contracts.
So it can export its inflation.
It can export its problems. But Italy is not the U.S. Italy is in the periphery, or at best, the semi-periphery of the Eurozone.
They use the euro, but they don't control the printing press.
Not in the same way. So when the core, meaning the U.S. Federal Reserve, decides to raise interest rates to fight its own inflation, what happens? Capital, money, gets sucked out of the periphery like a vacuum. Investors all over the world sell their Italian bonds and they buy safe, high-yielding U.S. Treasury bonds.
Which means Italy's borrowing costs go through the roof.
Skyrocket. Suddenly, the Italian government has to pay a much higher interest rate to borrow new money, and a huge chunk of its tax revenue is now going just to service the interest on its old debt.
And that's when the system forces its hand.
That's it. To avoid a full-blown default, institutions like the European Central Bank or the IMF have to step in, but their help always comes with strings attached. Conditionality, they call it. And the number one condition is that you must run a primary fiscal surplus.
That just sounds like painful jargon.
It is the mathematical definition of austerity. That's all it is. A primary fiscal surplus means the government must collect more in taxes than it spends on everything, except for the interest payments on its debt.
So you have to cut everything else.
Everything. You slash the school music program like in your friend's town. You freeze Roberto's pension. You don't repair the roads. You are effectively engineering a massive wealth transfer from the citizens of your country to the global creditors holding your bonds. The system is designed from the ground up to preserve the value of the financial asset, the bond, at the direct expense of the social fabric.
So Roberto, standing in that grocery aisle, he is the collateral damage of the financial world protecting its own. He is living down path number 2, austerity.
He is the face of austerity.
Okay, but let's pivot. Because while Roberto is dealing with a lack of money, there are other people in other parts of the world who are dealing with a different problem. Money that's rapidly losing its meaning. Let's talk about Sarah.
Sarah, yes, she represents the complete pivot to the real worldview.
So Sarah owns a hardware store somewhere in the American Midwest. She's not a financier. She's not an economist. She deals in copper pipe, lumber, bags of cement, drywall, real stuff.
Tangible assets.
Exactly. And I saw this video she posted. It was fascinating. She was just walking through her warehouse, looking at her inventory, and she described this surreal feeling she was having. Her bank balance, the number on the screen, was staying pretty flat, maybe even going up a little. But the amount of stuff, the amount of actual copper pipe that she could buy with that money was shrinking every single month.
The purchasing power was collapsing.
It was collapsing. And she said this thing that just stuck with me. She said, my grandfather used to say gold is money and everything else is just a promise.
That's $1 billion of economic insight disguised as simple folk wisdom. It's incredible.
And it led her to do something that, any business school professor would tell you was inefficient. She started hoarding inventory. She keeps almost zero cash in the bank. As soon as a customer pays her, she immediately uses that cash to buy more copper, more lumber, even if she doesn't have a buyer for it yet.
She's effectively demonetizing her own business.
Yes, that's the perfect way to put it. She trusts the physical copper in her warehouse more than she trusts the digital dollar in her bank account.
Sarah has, completely on her own, intuitively grasped the absolute central thesis of that Bretton Woods 3 report from Credit Suisse. This is Zoltan Pozsar's framework. He argues that we are in the middle of a historic transition, moving from a global regime based on nominal value to one based on real value.
Okay, we have to unpack Bretton Woods 3. I know Bretton Woods 1 was the gold standard, Bretton Woods 2 was the dollar standard after Nixon.
Yeah.
What does Pozsar mean by a third one?
So Bretton Woods I, post-World War II, pegged the dollar to gold. It was an outside money system. Bretton Woods II, starting in 1971, was the fiat dollar standard. The dollar was backed by nothing but the full faith and credit of the U.S.
The era of inside money.
The era of inside money. And during that period, the financial economy was king. The U.S. attitude, famously, was, our currency, your problem. The U.S. could print as many dollars as it wanted to solve its domestic problems, and the rest of the world had to deal with it. And that worked because we lived in a time of peace and hyperglobalization. That printed money could always buy cheap goods from China, cheap energy from Russia.
But Potzer is arguing that era is over.
He says it died the moment supply chains broke during the pandemic and a major war returned to Europe. In this new era, Bretton Woods III, the motto is no longer our currency, your problem. The motto is now our commodity, your problem.
Our commodity.
His most famous line from that report is simple but profound. You can print money, but you cannot print oil to heat or wheat to eat. Sarah knows this instinctively. You cannot print copper pipes. If the global supply chain fractures, $1 million in a bank account is utterly useless if it cannot actually procure the physical asset you need to run your business.
This fundamentally changes how we have to think about international trade, doesn't it? The report talks about the 4 pillars of commodity trading. We usually just look at one, the price.
That is the old Bretton Woods II way of thinking. In a world of scarcity, conflict, and fractured supply chains, price becomes secondary to availability. So yes, pillar 1 is price, but pillar 2 is what Pisar calls foreign cargo. Do you actually have the physical stuff? Do you have a relationship with the country that produces it?
It's not just about having the money anymore.
Pillar 3 is shipping.
Shipping, it seems so. Mundane. It's just boxes on boats.
Potzer argues it's the balance sheet of the real world. He emphasizes this over and over. If you want to move oil from the Middle East to Europe, you need a VLCC, a very large crude carrier. There is a finite number of these ships on the entire planet. If they're all booked, or if insurance companies refuse to cover them because of, say, war risk in the Red Sea, the trade stops. It doesn't matter if you have the cash, no ship, no oil.
And the 4th pillar?
Protection. This is where economics becomes naked military strategy. You need a navy to protect the supply lines, the Straits of Hormuz, the Malacca Strait, the South China Sea. During the peak of globalization, the U.S. Navy basically guaranteed safe passage for everyone. It was a public good. But in a fragmented, multipolar world, if you can't defend your cargo on the high seas, you don't really own it.
So Sarah, hoarding copper in her warehouse is her own small-scale version of securing foreign cargo because she can no longer trust the global shipping and protection pillars to function smoothly.
That's a perfect analogy. She's taking physical possession because the promise of future delivery is no longer reliable. And this connects directly to why that In Gold We Trust report is so obsessed with what central banks are doing.
They're doing the same thing as Sarah, but on a national scale.
Exactly. Sarah is moving from digital dollars to physical copper. The world's biggest central banks are moving from digital dollars in the form of U.S. Treasury bonds to physical gold. In 2022, they bought a record 11,136 tons of it. A record.
But why gold? If this new era is about the real world of oil and wheat and microchips, why go back to what Keynes called a barbarous relic?
Because gold is the ultimate form of outside money.
We need to define that term clearly. Inside money versus outside money.
Okay. Inside money is any financial asset that is simultaneously someone else's liability. Your bank deposit is an asset to you, but it's a liability on your bank's balance sheet. If the bank fails, your asset can disappear. A government bond is an asset to you, but it's a liability to the government. It depends entirely on the counterparty keeping their promise to pay you back. The entire modern financial system is built on this web of interlocking promises.
Outside money.
Outside money is nobody's liability. A bar of gold is just a bar of gold. It exists physically. It doesn't rely on a banking network, a government's credit rating, or a contractual promise. It just is. So when trust in the inside system begins to fracture, when Sarah stops trusting the dollar's future purchasing power, or when China stops trusting that its holdings of U.S. bonds are safe from seizure capital fleas to outside money, it is the only financial asset in the world that carries zero counterparty risk.
Okay, so we have the Western trap of financialization, austerity, crushing Roberto. We have the pivot to hard assets, the commodity rebellion with Sarah. But there is a massive third piece to this puzzle. We can't have this conversation without talking about the factory of the world. We have to look at the Asian model.
This is the great counterbet. This is the other path. While the West is trying to figure out how to manage the slow motion decline of its paper wealth, East Asia And China, in particular, is trying to build its way out of the crisis with tangible physical production.
I want to introduce a third character here, May. She's a young engineer. Let's say she's in one of these techno cities in East Asia. I've read these accounts of places that seem to just spring up overnight sprawling industrial hubs. May works 12, maybe 14-hour shifts in a state-of-the-art semiconductor fabrication plant. A fab. Her life is frantic, it's exhausting, but it's all about growth. And her entire reality, her apartment, the high-speed rail she takes to work, the factory itself, it was all built on a mountain of debt. But when I look at her situation, her debt-fueled reality, and I compare it to my friend with his refinancing and his banking app, the debt just feels different.
It is fundamentally different, and that China economist source we have makes this crucial distinction. In the West, we tend to lump all debt together. We see a big number and we say, that's bad. But they draw a very sharp line between what they call productive debt and unproductive debt.
So what is May's debt actually doing?
Well, the study analyzed China's massive 4 trillion yuan stimulus package after the 2008 crisis. They tracked exactly where all that borrowed money went, and they found that debt used for infrastructure, things like building new roads, upgrading the power grid, rolling out 5G networks, and for innovation subsidies, had this incredible positive feedback loop. It drives something they call talent agglomeration.
Talent agglomeration. That sounds like corporate buzzword bingo. Break that down for me mechanically.
Think of it like creating a center of gravity for smart people. If a city borrows $1 billion, not to build a fancy stadium, but to build a world-class subway system, affordable housing for engineers, and a cutting-edge research park, what happened?
People like May move there.
People like May move there. Then the big tech companies move there to be near the talent. Then, because all these smart people and companies are clustered together, ideas flow faster. Innovation accelerates. The suppliers who make the specialized equipment for the fabs, they set up shop right next door. Transaction costs plummet. The debt, the initial borrowing, creates a physical engine of growth that, in theory, generates enough real economic value to service the loan and then some.
And you compare that to unproductive debt.
Unproductive debt is borrowing money to buy an existing asset. So taking out a huge mortgage to bid up the price of a 2-bedroom apartment in London or New York, that doesn't create a new house, it just makes the old one more expensive. Or borrowing on a credit card to fund a vacation. That debt leaves you with a bill, but no new income-generating asset. May's debt leaves her with a factory that produces the microchips the entire world needs. It's a night and day difference in quality.
So the Asian strategy, in a nutshell, is this. We're going to take on absolutely massive amounts of debt, just like the West did. But we are going to use it to build and corner the market on the essential real-world goods of the 21st century.
That is the bet. That is the entire strategy. The thinking is, if and when the global financial system has its day of reckoning, they will still have the factories, the ports, the high-speed trains, and the energy grid. They'll have the real stuff. But there is a catch. And it is a very, very big one. The TD Economics report we looked at highlights this risk perfectly. The risk is excess capacity.
They're building too much.
They're building more than their own system can absorb. Right now, China has the capacity to produce far more electric vehicles, solar panels, and batteries than its own population can possibly consume. May is working herself to the bone to help build cars that her own neighbors can't necessarily afford to buy.
So where do all those cars go?
They have to be exported. They have to flow out into the rest of the world, to Europe, to South America, to the United States. And when that happens, it doesn't just transmit cars, it transmits a wave of deflation.
Because they can make them so cheaply, it pushes prices down everywhere else.
And this is the direct cause of the trade wars we're seeing now. It feels like every week there's a new tariff on Chinese EVs or solar panels.
It's a defensive reaction.
It's a purely defensive reaction. The West, particularly the US and Europe, looks at this flood of cheap, high-tech goods and says, wait a minute, you are using state-subsidized productive debt to systematically wipe out our remaining industrial base. It's not just friendly trade competition anymore, it's a strategic conflict over who gets to retain the ability to manufacture things in the 21st century. May isn't just an engineer, she's a soldier in an economic war, generating the real output that the West is now deeply afraid of.
So, okay, let's just lay out the pieces on the board. We've got the Western financial trap, which leads to austerity for Roberto. We've got the commodity rebellion, the pivot to real assets, which Sarah's living. And now we have the Asian industrial drive, which is May's reality of building excess capacity. These three forces, They cannot coexist peacefully forever.
No, they are fundamentally incompatible. And this leads us to the final and, frankly, the most volatile part of this whole deep dive, the geopolitical showdown. The In Gold We Trust report is very clear on this. It argues that this tension can only resolve itself through one process: de-dollarization.
Okay, I have to pause you right there because I have been hearing about the death of the dollar for 20 years. It's a recurring theme. And yet it never happens. The dollar is still used for, 80% of trade finance, 60% of global reserves? It's still the king. Why would this time be any different?
One word: weaponization. The report makes a very compelling case that February of 2022 was a watershed moment. It was a line that was crossed when the United States and its G7 allies made the decision to freeze $300 billion of the Russian central bank's foreign reserves. That changed the calculus for every other nation on Earth.
Now, morally, a lot of people in the West supported that move as a response to the invasion.
And we are not here to discuss the morality. We're here to discuss the banking physics of that decision. If you are the finance minister of Saudi Arabia or Brazil or India or even China, you watched that event and you had one terrifying realization.
Which was?
My savings held in US dollars are not truly mine. They are conditionally mine. Their ownership is permitted by the United States government. If the political winds shift, if we have a disagreement, those savings can be made to vanish with the stroke of a pen. It transformed the dollar from a neutral, boring reserve asset into an active political lever.
So it forced every country that isn't a staunch U.S. ally to start building a financial fire exit.
A fire exit, that's the perfect term for it. It dramatically accelerated the formation and the seriousness of the BRICS bloc, what the report calls the G7 of the East. And they're not just holding summits and making speeches anymore, they are actively building new plumbing.
There's that word again, plumbing. You mentioned it earlier with Sultan Patsar. What does this new non-dollar plumbing actually look like?
Okay, look at a project called the MCBDC Bridge. This is a real pilot program involving the central banks of China, Thailand, the United Arab Emirates, and Hong Kong.
MCBDC Bridge. Sounds pretty innocuous.
It is the opposite of innocuous. It is revolutionary. Right now, if a company in Thailand wants to pay a supplier in the UAE, how does that transaction usually happen?
It goes through the dollar system.
Right. You have to convert your Thai baht into US dollars.
Yeah.
Those dollars move through a correspondent bank in New York. Their ledger gets updated. Then the dollars are converted into UAE dirhams. The US banking system sees the transaction. The US government sees the transaction. And if it wants to, the US can stop the transaction.
So they have a kill switch. And the bridge.
The bridge is a shared digital platform that allows those central banks to swap their new central bank digital currencies directly with each other. It's peer-to-peer at the sovereign level. Atomic settlement, no dollars needed, no New York correspondent banks, no SWIFT messaging system. It is a fully functional technological bypass around the entire US-centric financial empire.
Wow. That's massive. So if the U.S. decides to sanction a country, they can just flip a switch and start trading on this parallel track.
That is the explicit goal. And we are seeing the early evidence of this fragmentation everywhere you look. Saudi Arabia seriously considering accepting the Chinese renminbi for oil, the petroleum. Ghana announcing it will buy oil directly with gold. India and the UAE agreeing to settle their bilateral trade in their own currencies. The report concludes that this isn't a single event, but a steady process towards a multipolar future. One world, two systems.
Let's paint that picture. What do those two systems actually look like in this future?
Well, Zone 1 is the traditional dollar bloc, the US, Europe, Japan, Australia. It's highly financialized, it's service-based, it's democratic in structure, but it's also heavily indebted and completely reliant on the smooth functioning of that inside money system of promises.
Okay.
Zone 2 is the emerging commodity industrial bloc, led by the BRICS nations. This zone is resource-rich, it's focused on industrial production and manufacturing, and it is increasingly anchoring its trade in gold and other forms of outside money because they've lost trust in the promises of Zone 1.
And where does Europe fit into all this? Where does that leave Roberto?
Europe is in the most precarious position imaginable. The report notes French President Macron's constant calls for strategic autonomy, but the reality on the ground is brutal. Europe's post-war economic model was built on three pillars: cheap Russian energy, access to the massive Chinese export market, and the U.S. security guarantee.
And now
Now it's been cut off from the cheap energy. It's facing a trade war with China over excess capacity. And as a result, it is more dependent on the U.S. for both security and energy than at any point since 1945. Roberto is being squeezed not just by his own government's debt, but by these massive geopolitical tectonic plates shifting right under his feet.
it really does feel like the unipolar moment, that post-Cold War era, is officially over. The core idea that we could just print our way out of any problem, that the perpetual money machine would run forever, that assumption is broken.
The gears have ground to a halt. The debt load is simply too high, and more importantly, the real world has stopped accepting the paper promises at face value.
So let's bring this all the way back. Back to the three bitter paths we outlined at the very start. The three poisons we have to choose from.
Path 1 is inflation. We simply erode the value of the $300 trillion debt pile by making the currency it's denominated in worth less and less every year. This is the path that Sarah in the hardware store fears. It's effectively a slow-motion default on the saver to protect the heavily indebted borrower. It's a hidden tax on everyone who holds cash.
Okay, path 2, austerity.
We try to honor the paper debt by systematically gutting the real economy. We slash living standards, we cut public services, we freeze pensions, all in a desperate attempt to pay the bondholders back with sound money. This is Roberto's reality. And it inevitably leads to social decay, political extremism, and state failure.
And that leaves path 3, default. A full reset.
A full reset. The system just seizes up, trust evaporates completely. This is the ultimate risk of the geopolitical showdown, a chaotic fragmentation of the global economy where trade grinds to a halt because no one trusts anyone else's currency or promises anymore. It's the lights out scenario.
That is not a cheerful menu of options.
It isn't. But pretending there are other painless options on the menu is no longer a viable strategy. Understanding that the menu itself has changed is the only way to navigate what's coming.
I want to leave everyone with one final thought. It's from that Credit Suisse report. And it's really about the fundamental mindset shift we all need to make. For the last 40 years, our entire civilization, our pension plans, our home values, our government budgets has been optimized for one thing: the price of money. We obsessed over interest rates, foreign exchange rates, stock prices. But the next 40 years are almost certainly going to be defined by something else. The availability of things, real things, energy, food, clean water, microchips. The critical question is no longer, what is your net worth in dollars? The real question is, what can those dollars actually buy you when the global supply chains fracture? As we saw with the school board meeting in that opening story, the money might exist on a screen, but if it can't keep the music program running, if it can't put that block of cheese in Roberto's basket or that copper pipe in Sarah's warehouse, is it really wealth at all? That is the $300 trillion question.